the news continues to come out of China on a daily basis, and it's not just plain old news, it's always the big news coming out of China. For example, we've had the crypto, Chinese government cracking down on crypto exchanges, and then as far as the property investment, they're curtailing Chinese people, taking their money out of the country and buying property around the world, including Australia, in particular Melbourne and Sydney. So what they've done now, the Chinese authorities are actually looking at the large property developers who have bought into the land and have developments on the table, but the government has actually said, we don't want you to do that, we don't want you to take the money out of the country, it's not good for the country, this sort of outflow of capital is just not healthy. So in addition to Chinese private retail buyers having a lot of difficulty plowing into international housing, now it's the big guys that are having the same trouble. But don't take my word for it. As always, I've got a clip for you. It's a very interesting one, and see how that pans out.
Welcome to The Business. I'm Elise Morgan. Coming up on the program, China's spending spree on Australian property cooling by some developers walking away from big deals. And buyer beware on home loans. How much do borrowers know before signing their lives away? Australia's property market rests on the suspect foundations of burgeoning household debt and Chinese investment. Now Beijing has put the brakes on money flowing out of China, particularly for property investment. Analysts say the crackdown is already having an impact, with some Chinese players quietly searching for alternative funding. The move threatens to undermine prices, but it could also create opportunities. Here's finance correspondent Philip Lasker.
Is this what a withdrawal of Chinese money from Australia looks like? A landmark Sydney property at Circular Quay, bought by Chinese commercial property giant Dalian Wanda Group, now flanked by blank hoardings. At one point, they proudly displayed signs of the company's vision for its so-called Sydney One project, a billion-dollar construction project consisting of two massive towers, one residential, the other a hotel.
Chinese developers that have been overpaying for properties in Australia are now struggling to find the finance to close on those deals, and they're actually walking away from rather large deals and large deposits.
You will see me comment very little during this clip, because I couldn't have said it better myself. I mean, there's almost nothing I don't agree with in this clip, and pretty much everybody being interviewed here. I mean, it's kind of obvious to everyone, you know, this is going to have a huge impact on property prices in Australia, but we keep saying this, and I apologize if I sound like a broken record. It just hasn't happened yet. You know, all the signs are there, and they have been here for 12, 24 months, but it just hasn't happened. The property continues to go up against all the predictions and all the business and property cycles that I've looked into. So I don't know if I can believe this. I do tend to agree to this clip and this program, but I don't know. It might not happen.
These authorities, anxious to stem the outflow of money from China and stabilise the yuan, have tightened restrictions on foreign investment by their companies. The concern is that China's financial stability is threatened by the capital outflows exacerbated by property developers. The Chinese government described the overseas property buying spree as irrational.
Paying money for trophy investments or bragging rights, you know, paying over the odds in the expectation that there is more capital coming through, you know, those days specifically are over.
Hong Kong developer Country Garden paid a record $400 million for this parcel of land on the outskirts of Melbourne just a few months ago. There's keen interest in whether any of the planned 4,000 homes will be built in a hurry. The Chinese government's new directive encourages investment in resources, agriculture and technology, but property like hotels and residential, as well as sports and film investments, are now on the restricted list. Dalian Wanda is one of the companies Chinese authorities are watching more closely, and the Sydney One site is clearly a project Chinese authorities would have considered restricted.
I think some developers who have, perhaps not started projects yet might be looking to sell their sites on sale, or just, wait and see attitude and just hold it. Others that have already started, chances are they would have already got funding for it and would go through the whole process. And in that process, they would have already pre-sold a substantial amount of the planned sales.
If the developers haven't lined up their funding, it's unlikely the Australian banks will help them out of what could be a terrible bind.
Right now, in order to get a construction loan from an Australian bank, you really have to have pre-sold 100% of the building, and none of that can be to foreign buyers. Now, a Chinese property developer who may be in trouble has probably already sold 50% to foreign buyers, so they don't meet the criteria unless, of course, they unwind those transactions and then pre-sell it to Australian residents.
That's why some Chinese developers are searching for non-bank funding. Adding to the uncertainty is this month's Communist Party Congress, where there could be major changes in the party's leadership and the makeup of its top decision-making body, the Politburo Standing Committee.
There is a view that capital controls will be further tightened after the Party Congress, that it is a topic for discussion at the Party Congress.
Tim Murray says the yuan may come under pressure again as US interest rates and the dollar rise and Chinese property prices soften after a strong run. It could also herald the return of some investors looking for a bargain.
I think the capital restrictions are effective on property developers because that's large loans through large banks and other equity controls that the government can put in place. However, for the smaller investor that's buying properties, it could well be that they'll return to the market in 2018.
Chinese property developers, who snapped up a massive 38% of residential development sites last year, won't vanish completely either. They may be forced to search Australia's cheaper, smaller cities and regional tourist centres.
I think Australian developers have been sitting on the sidelines looking at the crazy prices that are being paid for development sites, and now they're thinking that time for them to return to the market is coming back.
The tables have well and truly turned. The Chinese government helping give Aussies a leg up in their own backyard. Who would have thought?
I mean, like I said, I really have nothing else to add to this, but I would be very cautious in jumping in now. I know that it said that Australian developers may have an opportunity now to get a bid in and get something at a reasonable price, but I think it'll take a lot longer before you're able to look at the property and say, hey, this is actually now affordable, because it would have to pull back 30, 40, 50%, and that's not impossible. So if it goes back 10, 20% and we all think, oh yeah, it's a bargain, well, think again, because if it continues to go down and being a very slow property cycle, it could take another few years, if not, longer than that, before it finally hits the bottom. So I would sit tight still for foreseeable time.
Who would have thought? Philip Lasker there. The International Monetary Fund warns Australia's household debt level is too high. The IMF says Australia's high levels of debt leave us potentially exposed to a global economic shock or a banking crisis. An IMF study into highly leveraged households and financial stability singled out Australia. Household debt here has risen to 100% of GDP. That's well ahead of other advanced economies where the ratio is closer to 63%. But the IMF warns the global level of household debt remains high by historical standards. Sticking with debt, and up to a third of home loan borrowers with interest-only loans may not even realise they have them. That's the surprising new research from global investment bank UBS after a survey of more than 900 people who'd taken out a home loan recently. The research is a follow-up to UBS's report into liar loans, which found up to a third of people had given inaccurate information on their loan applications. UBS says it's cross-checked the results against official data. The report authors voice concern that, as a result, borrowers aren't aware that repayments will jump by 30 to 60% at the end of the interest-only period.
Interest-only loans, gotta love those. I've got a video on that, so have a look at my channel, subscribe. There is a section where I talk about these interest-only loans, also the liar loans, where people essentially are making things up, especially the income, to be able to get those loans that they clearly can't afford, but they kind of can until the interest rates go up by even a little bit. But I hope you enjoy this. There's more to come. Subscribe. I've got another video just coming up. I'm about to make it right now. Alright, take care everyone.